Good afternoon, everyone. Thank you very much for joining us today. It's really a pleasure to see all of you and to be able to take you across this journey that we hope we are going to share in the long term. And since you are all, I think, very much intent in this room on improving social impact, I'm going to start by focusing on the outcome we're trying to contribute to through this conversation over the next 2 days. And that outcome really is one of a world that is resilient and where everyone, including low-income households, individuals, and smaller firms, are equipped to face, go through, and recover from shocks in the right way. And of course, you've heard from the video that this is incredibly timely because our world is going through shocks of different natures, of increased intensity, of increased frequency, and of increased magnitude. And whether we think about economic pressures, cyber risk, financial crises, climate events, or the pandemic or other health-related shocks, they seem to combine in their forces recently to just hit us harder fundamentally. And what's more and more concerning for us is that these shocks affect low-income populations and small firms the most. And that is very much related to their livelihoods, the fact that the majority of them work in agriculture and live in rural areas, weak urban settlements, or even in fragile contexts. And so a world where everyone has access to the tools they need to face shocks, go through them and recover from them in a way that is not regressive, where they don't have to reduce consumption, to take their girls out of school, to sell assets in a fire asset sale, and where they can recover from the shock, recover the destruction of assets and income that might have occurred. Now, why does that matter? Why does it matter that everyone is resilient? Of course, it matters first because the shocks are increasing, and that's what I was explaining, and they're becoming more damaging and they're hitting everyone. But it also matters because fiscal resources have become scarcer recently in emerging markets, especially as the pandemic led to significantly higher debt levels in many emerging markets, and therefore eroded fiscal spaces. Therefore, it is more important than ever before that we equip people to build their own resilience in a way to decrease their dependence on government-led resilience initiatives. But leaving no one behind and protecting everyone with resilience is also very important because it allows to avoid the often negative spillovers that come with a lack of resilience in any part of society, whether it is through social tension, potential social tensions, migration pressure, or just the spreading of a disease if part of populations are not protected. And so you probably have seen quite a lot of reports recently, including ours, entitled Rethinking Resilience. And that is indeed because we believe that it is time to rethink resilience, but to rethink it in a way that leaves no one behind, in a way that empowers everybody to build their own resilience and to bring private solution. But we'll expand on that in a minute. So how do we get there? Well, in fact, that's exactly where we believe that inclusive finance can be one of the most effective tools to do exactly that, to enable people to take care of themselves, to receive and access and use the tools they need to go through a shock without relying on regressive strategies and to recover from a shock faster and better. And the evidence that we have collected through the Impact Pathfinder, which is an open source platform that CGAP has prepared and released a few months ago, confirms that. It confirms indeed that digital payments, whether they are for friends or families or remittances, as well as saving products, insurance payouts, and credit, all contribute to helping low-income households and small firms better survive through shocks without resorting to regressive strategies and building back better after a shock. And I'm going to give you several examples to make it really grounded. So if we start with digital payments, you may know that in Mozambique, after the January 2021 flooding, those of the local population that had e-wallets on their mobile phones were the first to receive payments, emergency funding from friends and families. And long-term evaluation shows that their resilience was not only better in the short term, they were better able to handle the shock, but it remains stronger in the longer term. Not with a climate-related event, now moving to a fragile country in Sudan, at the time when the conflict erupted, those who had access to the mobile app of the Bank of Khartoum were able to continue with their daily lives without carrying cash in their pockets in a conflict environment, therefore increasing not just their economic resilience, but even their physical resilience. If we go to savings now, evidence from Kenya, for instance, shows us that women that are part of saving groups at a time, were 66% more likely to invest in preventive health than women who are not part of these groups, including buying, for instance, mosquito nets or water chlorination systems, etc., thereby increasing their health resiliency. If we turn to insurance, there's a lot of examples I could give, but we have examples again from Kenya that shows that people who were insured at the time of climate shocks were 96% less likely to sell assets than people without insurance in the same communities. And even credit increases resilience. And there we have examples from Latin America and Southeast Asia, a cross-regional study that shows that borrowers were 20% less likely to sell assets if they had access to credit at the time of a shock. In other words, it provided them with the liquidity that they needed. Now, very interestingly, these products have additional benefits. And the first benefit is that they also create positive economic incentives, leading fundamentally to lower risk aversion in the face of repeated climate shocks. So for instance, if we look at BRAC in Bangladesh that has piloted a contingent credit line, so this is an instrument by which smallholder farmers are pre-approved to access a loan and withdraw the money when a climate index is triggered. An evaluation shows that these people increase their yields by 36% through increased production and therefore increase their income compared to those who did not have access to this credit line, because fundamentally their risk aversion to losing everything they would have paid for in their harvest would be destroyed. Secondly, we also see that inclusive financial products contribute to climate adaptation and facilitate the acquisition of green technologies by low-income families and small firms. And that leads in turn to greater climate resilience, but also a just green transition, enabling them to participate and benefit from green technologies. And there, an example that I guess everybody in this room is very familiar with is the PAYGO industry, which allows to defray, for low-income families, to defray the cost of acquiring a potentially expensive green tool by paying in proportion to their usage of the tool, and which has enabled millions of people across the world to acquire solar home-based systems or, for instance, solar-powered irrigation systems. Last but not least, we also know that small-scale pensions or old-age savings have the potential to potentially defray very high fiscal costs in aging population context, which are affecting many more countries in the world. And very importantly, we also know, all of this is evidence from the Impact Pathfinder, that inclusive finance supports the creation, the growth, and the sustainability of entrepreneurs and micro firms and small firms, thereby leading to the creation and the preservation of jobs, increasing, therefore, economic resiliency. And I'll give you an example, again, from a big survey in Latin America and Southeast Asia that showed that 20% of firms across these two continents that adopted digital finance services recruited more paid workers. And that was not just because they got access to more working capital, but also because that led in turn to business improvements, accelerated innovation in product design and processes, etc. Now, what's more is the fact that this industry is ready. It is set up in such a way that it is de facto already effective in doing just that. So if you think about microfinance institutions, inclusive banks, digital banks, inclusive insurance companies, fintechs, these are companies that have for decades channeled large amount of fundings, which they raise from markets and from donors, into small financial services and products to low-income households and small firms to build their resilience and their economic prosperity. They have a long track record of impact. They have fiduciary standards that they had to raise to meet investors' and donors' requirement. And for decades, they have been serving people at the last mile effectively. Therefore, as I said before, we really believe that it is time to rethink resilience strategies, and especially to include inclusive finance as one of the tools, one of the avenues to implement national resilience strategies. What inclusive finance can do fundamentally is complement government-led resilience strategies at national level by empowering people to take care of themselves. What that does to some effect is to provide mostly a private solution to what is typically being thought of as a public problem. Of course, it doesn't work for all shocks. There are shocks that are too large in scale or too covariant across populations to be handled privately. But the potential for many shocks is underexploited today. Now, if it hasn't happened enough so far, and if we are meeting today to push that agenda, is because there are obstacles along the way. And one of the key obstacles is the one that Ajay Banga mentioned, which is that really there are still enormous gaps in financial inclusion across the world. And just to give you some numbers, it is striking that still, Ajay said 1.5. I think the new Findex will show it's improved a bit, but fundamentally, nearly 1.5 billion people in the world don't have access to even a more simple bank account, not even an e-wallet account, nothing. They work in cash, basically. And what's very worrying is that the pace of progress is slowing down, which basically means that reaching the last mile is getting harder and harder. These are people that are excluded not just from finance, but from markets, from infrastructure, from literacy, etc. And strikingly, in countries that are susceptible to climate change, so where building resilience is particularly relevant, 1 out of 3 is financially unbanked completely compared to 1 out of 10 in the rest of the world. We also know that while access to digital payments and usage of digital payment is growing very fast, and it has continued, the cost of remittances remains really expensive, 6.2% on average. And remittances are a key emergency line for many people. We also know that there's about 4 billion people in emerging markets that are either uninsured or underinsured. We also know that only 29%, if I remember well, yes, of adults are saving at a formal institution, and only 23% have access to credit from a formal institution. And the MSME financing gap is a stunning $5.2 trillion per year, according to the IFC. And most informal workers in the world don't have any pension fund to protect them from old age poverty. So because of these gaps in access to finance, obviously the resilience of people is very weak, and that's exactly the problem we're trying to solve. According to Findex, only about half the people in developing countries could raise enough funding to face an emergency in 30 days, which is a massive amount of time. You can imagine if you have an accident, you want to solve that before 30 days, right? And within 7 days, it's only 30% of people in developing countries. And most of that money would come from friends and families. So they don't have the financial buffers that we would rely on to face a shock in our life. As a result of that, the financial health of people in the world in general, not just in developing countries, is very weak. And we don't have data from many countries, and we're going to have somebody else give you much more details on that. But fundamentally, if I take just 3 data points, we see that in Brazil, 2/3 of citizens are saying that they are worried about their financial futures. In the Philippines, half the population say that their financial savings would not be sufficient for rainy days. And in South Africa, where they have a measurement system for financial health, it has decreased from 31% to 16% of the population over the last 3 years. It's also very important to realize that women are disproportionately excluded from access to finance compared to men. And that really matters because women play very important roles in the resilience of their families and of their communities. They are typically in charge of decisions related to food, education, and they also typically play very active roles in climate, in their community, at the level of their communities, in climate adaptation, biodiversity, and even peace, actually, in developing countries, in fragile contexts. And therefore, ensuring that women have access to the financial services they need to build their resilience and that of their families is fundamental too. I just want to add that there is another obstacle that is very important, and that's the fact that we operate regularly in silos. And therefore, to address this problem, we also will need to break silos, drive collective action, and focus squarely on outcomes. Think about your own companies and your own institutions, and think about whether those who work on resilience, how often they talk to those who work on inclusive finance. In many institutions, experts who work on climate, experts who work on social protection, experts who work on fragility, experts who work on health, don't see inclusive finance as part of their toolkits to achieve their objectives. And vice versa, those of us who work on inclusive finance have traditionally focused mostly on increasing access to financial services and usage, rather than focusing squarely on ensuring that access we were fomenting would in fact increase the resiliency and economic prospects of clients. So this leads me to my last slide, which is the change is in our hands. We can make that happen. And that's exactly why we have convened this symposium. And that is exactly why we have invited not just inclusive finance, financial inclusion friends, but also institutions and experts on fragility, on social protection, on climate change. Because we hope that if we work together to systematically increase the breadth, the depth, and the impact of inclusive finance on resilience, and if we break silos and if we include inclusive finance in resilient strategies, then we will be able to increase the resiliency of everyone, including low-income populations and small firms, improve financial health, and fundamentally create hope for societal resilience. And so we hope that you will join us in that journey. And of course, we know also that we will need technological innovation to get us there. And this forum will exemplify how we can achieve that together. So now I'm available for questions. Thank you.